On May 15, 2026, something may happen that most Americans will not notice until long after it begins affecting their wallet. They will not see it first in a dramatic headline. They will not see it first in some giant emergency speech. They will see it later in the cost of borrowing, in the value of their cash, in the price of assets. And in the quiet way, the financial system starts rewarding one group of people while punishing another. That is how these shifts usually work. The event happens first. The public understands it later. And by the time the public understands it, the people who knew what was coming are already positioned. What is changing? The chairman of the Federal Reserve is changing. And that matters more than most people realize, because the Federal Reserve controls the strongest currency in the world, the pricing of money, and the direction of the financial weather underneath everything from mortgages and credit cards to treasury debt and stock valuations. Now, let me say something carefully. The Federal Reserve may be called the Federal Reserve, but it is not federal in the way ordinary people assume. The White House cannot simply storm in and order the chairman around. That is why there was so much tension over the current chair. The president could complain. The president could pressure. But he could not simply fire him and install a more obedient operator on the spot. What changes on May 15th is not the law. What changes is the seat. The term expires, and when the seat opens, a new chairman can enter with a very different agenda. That is why I want to walk through this carefully. Because if Kevin Warsh arrives with the kind of approach the source material lays out, then the debt problem in the United States will not be solved by honesty sacrifice or repayment in the way ordinary people imagine repayment should happen. It will be solved the way governments have often tried to solve impossible debt burdens, by making savers poorer, by making asset owners richer, by making the currency do some of the painful work that politicians do not want to do openly. That is the real frame. Before we talk about the plan, we need to talk about the problem. The United States now has more than $39 trillion of national debt. People hear numbers like that and become numb. That is understandable. Once the number gets large enough, the human brain stops emotionally processing it. So let me simplify it. The government has one real source of ongoing revenue, tax dollars, and the fastest growing major expense is not military spending. It is not infrastructure. It is not schools. It is not research. It is interest. More than $1 trillion a year is now going toward interest on old debt. That means more and more of every tax dollar is being used not to build anything new, not to improve your life, not to invest in your children's future, but simply to service the burden of what was already borrowed. That is what a debt trap feels like when a country gets rich enough and large enough to disguise it for a while. Now, a lot of people assume the way out of this is simple. Pay off the debt. That is not how heavily indebted states behave. That is almost never how the story goes. States do not usually solve impossible debt burdens by becoming suddenly disciplined saints. They solve them through some version of inflation, repression, or rule changes that quietly transfer wealth away from savers and toward debtors and asset owners. That is what history shows. And if you want the American example, go back to the years after the Great Depression and World War II in 1946. U.S. debt relative to GDP was over 100%. The debt burden was enormous. The country had a debt crisis. But here is the important part. The United States did not truly pay that debt off the way a family pays off a mortgage by tightening its belt and writing checks until the loan disappears. Instead, over time, the debt to GDP burden became much smaller because the economy grew faster than the debt burden grew. That sounds clean. It was not clean. It was engineered. That engineering is what people call financial repression. And I think you need to understand that phrase because it may become one of the most important phrases of the next phase of American finance. Financial repression sounds technical. It is actually very simple. The government and the central bank work together, directly or indirectly, to keep interest rates lower than inflation while channeling money into government debt. That is how the state borrows cheaply, devalues what it owes, and lets time plus inflation do the dirty work. In practical terms, this means savers lose. If inflation is 5% and your savings are earning 1% or 2%, then you are losing purchasing power even if the nominal number in your bank account goes up slightly. Meanwhile, the government is borrowing at rates below the inflation rate, which means it is effectively being subsidized by the people holding cash and low-yielding paper. That is not an accident. That is the mechanism. Back in the 1940s, 1950s, and into the following decades, the Fed kept rates very low while inflation often ran meaningfully higher. At the same time, regulations and structural pressures effectively pushed banks, pensions, and institutions into holding government debt. The institutions lending to the government were not always doing so because it was the most attractive free market opportunity. They were doing it because the system was designed that way. So the government got cheap financing, the economy expanded, nominal GDP rose, and the real burden of the old debt became easier to carry. That is what happened. Now compare that to the present. Today, the United States is not sitting at 25% debt to GDP. It is sitting around 125%. So by the metric that matters most for sustainability, the starting problem now is worse than the post-war problem. That is why people are so focused on the incoming chair, because the debt burden is now large enough that the policy regime matters immensely. And this is where another difference becomes very important. Back in the older era, the government locked in long-term debt at low rates, 10-year debt, 20-year debt, 30-year debt. Today, the U.S. debt structure is much shorter. In plain English, it is as though the government is carrying an enormous adjustable rate mortgage. That means interest rates matter even more now than they did then. If rates stay high, the cost of servicing the debt climbs brutally. If rates fall, the pressure eases. That is why the political pressure to cut rates is so intense. It is not just about growth, it is about survival of the debt machine itself. Now let us get to Kevin Warsh. If he becomes chairman and the plan discussed in the source material becomes real policy, then the outline is fairly clear. First, cut rates. Second, shrink the balance sheet. Third, rely on AI-driven productivity and cost reduction to offset the inflation danger created by easier money. That is the plan in broad terms. Start with the first piece. Lower rates. President Trump has made it quite obvious that he wants lower rates. Why? Because lower rates make debt cheaper. Lower rates make refinancing easier. Lower rates support asset prices. Lower rates help the economy feel better in the short run. And if inflation is sitting around 3%, while policy rates are forced below that level, then you are effectively back in the territory of financial repression. That is the key. The government can borrow more cheaply. The real burden of its debt becomes easier to carry, and the people who suffer are the ones sitting in low-yield savings while the currency is being slowly weakened. That is why I keep saying the debt problem does not get solved, it gets transferred. The second part of the plan is shrinking the Fed's balance sheet. Now this is where things become more complicated. The Fed owns enormous quantities of treasuries and other assets because when the government needed financing and the private market was not enough, the Fed printed money and bought debt. That is what balance sheet expansion really is. The Fed creates money and uses it to buy assets, especially government debt. If Kevin Warsh wants to reduce that balance sheet, then in theory the Fed would sell some of those holdings back into the market. That sounds disciplined. It sounds anti-inflationary. It sounds like a neat way to say we can cut rates but do not worry because we are also pulling liquidity out elsewhere. Fine, that is the theory. The problem is supply and demand. If one of the biggest buyers of treasuries becomes a seller, then in normal circumstances treasury yields should rise, not fall, because the market now has more supply to absorb. That is exactly where the plan gets delicate. How do you cut rates? Keep treasury yields low enough to help the debt machine, and at the same time shrink the balance sheet without causing funding stress. The answer offered is that private demand will step in, banks, pension funds, institutions, investors, maybe foreign buyers. That is what has to happen. If the plan is going to work smoothly, and if it does not happen naturally, then history offers an uncomfortable reminder. Governments can change rules, not always openly, not always with a headline that says, "We are now forcing institutions to fund us," but through regulation, capital rules, incentives, or restrictions that make government debt more or less compulsory in practice. I am not saying that is guaranteed. I am saying that is part of the historical rhyme people should keep in mind, because when states need financing badly enough, they become very creative in making government debt attractive or unavoidable. Now let us move to the third part of the plan, AI. This is where the optimism enters. Kevin Warsh's argument in the framing of the source material is essentially that productivity gains from AI can offset inflation. If businesses become more efficient, if labor costs are substituted or supported by better automation, if processes speed up, Then maybe rates can be cut without reigniting runaway inflation because the productive side of the economy is improving at the same time. That is the hope. And I want to be fair, that hope is not insane. AI may very well reduce costs in many industries. It may improve margins. It may accelerate productivity. It may help companies do more with fewer people or fewer frictions, but here is my concern. The debt problem is here now. The refinancing pressure is here now. The policy need is here now. AI may help over time, but debt markets do not always wait patiently for technology to make politicians look smart later. That is why I think the real story remains financial repression, not technological salvation. The technology story may help sell it, it may help soften it, it may even make it more sustainable than it otherwise would be. But the core of it is still the same. Lower rates, inflation pressure tolerated, savers sacrificed, debt diluted. That is the mechanism. Now, if that is the mechanism, then who wins and who loses? The losers are the people who think they are being prudent by doing nothing except sitting in cash, low-yield bank products and paper promises that do not keep up. That was true in prior repression regimes, and it is likely to be true again. You think you are safe because the statement balance is stable, but if your purchasing power is shrinking faster than your nominal yield is growing, then you are not safe. You are just being quietly taxed through inflation. The winners are not all the same. And this is where people get confused. There is no single perfect asset across every inflationary or repressive cycle. Sometimes stocks lead, sometimes real estate leads, sometimes gold leads. Sometimes a combination of real assets and productive businesses does best. The point is not to find one universal winner. The point is to understand that asset ownership is the correct side of the line and passive saving in weak paper is the wrong side. That is the principle. Inflation makes the rich richer not because the rich are magically better people, but because they tend to own assets while ordinary savers tend to own claims on currency. And when the currency is being weakened, that difference becomes everything. This is why I keep coming back to the same simple lesson. You have to convert part of your paycheck into assets. Not someday, not when everything feels calm again, not after you are ready. You have to start. Because if financial repression really is returning in some modern form, then the people who stay loyal to cash and safe-feeling nominal products will be financing the relief of the debt problem for everyone else. That is how the system works. Now, I want to say something honest here. This does not mean markets go up in a straight line. The post-war decades included recessions, corrections, and ugly stretches. The same thing can happen here if we get easier money, lower rates, asset support, and mild or persistent inflation. That does not mean every quarter is pleasant. It means the long-run bias favors ownership over idleness. That is the important part. So if I had to reduce all of this to one clear takeaway, it would be this. The new Fed Chair's real plan is not to cancel the debt by paying it off. It is to make the debt easier to carry by holding rates down, tolerating inflation, leaning on growth, and quietly shifting the burden onto savers. That is what financial repression always is. The government becomes richer, the saver becomes poorer. The asset owner gets a chance to move ahead. That does not make it fair. It does make it predictable. And if it is predictable, then you do not need to be a victim of it. You need to understand it, position for it, and refuse to let your financial life remain trapped in the part of the system designed to absorb the pain. Because on May 15th, if this shift really begins in earnest, most people will not hear about it first from the Fed. They will hear about it later from their own wallet. And by then, the people who understood the game early will already be playing a different one.